want us to behave. Come on.
We're going to go back over, we're going to spend time to go back over the base plan and not worry about the, and I think it's important that I also stress to you that we don't expect any of you to go out and do this on your own after today. Whenever I've trained somebody to be a farm analyst, I think it takes anywhere from 3 to 5 visits with an experienced person before you get to the point where you feel comfortable doing this on your own. And if nothing else, if after 2 or 3 visits with an analyst, whether it be Mark, Lavelle, myself, or Coy, or Fred out in western Kansas, if we can get you comfortable enough after 2 or 3 tag-along visits with us to feel comfortable, you could go out and at least get basic data put together, balance sheet and budgets. That's a big plus for us then. And you can put together the information for acres and the whole farm expenses. Then we can come back with you and more rapidly use our time to help find solutions. So it is, I know today is like drinking out of a fire hose. You can only get so much at a time. But I want to assure you that if you'll hang in there with us after you do several of these with somebody that's experienced at it, you'll get more comfortable. And so that's our goal, is to make sure you hang in there with us, and we don't expect you to solo by any means. Not for a while anyway. I often say it takes a good year of work at this before I have analysts trained to the point where they feel comfortable going out. But Lavelle's worked for me off and on for 5 years, and she'll run into a problem that she can't figure out, and so she'll consult with me. Mark's done the same thing. Fred and I hired Fred 20 years ago. Fred's worked out in western Kansas to the extent that he has time to. He works with about 6 to 8 clients a year. I work with about 80. Lavelle is working with probably about 20 some. Coy has been semi-retired. He's 74, I think. Coy and I started together. Coy is still doing a few of them down in the Wichita area. And so consequently, doing 80 is more than I can really handle and be effective, and that's where you come in to help us with new referrals and get to the point where we can spread our resources out better. So anyway, we want to kind of go back over the base plan with you and answer any questions that you have as we go through it. And so I guess the best thing to do here, Kevin, you got anything to add? Okay. The best thing to do is let's start at the beginning and as far as the budgeting is concerned and the balance sheet. Questions about the issues that we raised on the budgets and the balance sheet. No question is dumb. So we'd like to know, are you comfortable with everything we've been able to relate to you in regards to putting together an effective financial statement? And any questions on the budgets that we put together? I know that the livestock formulas for feed use and so forth are a bit of a challenge, and that's just going to take some time to work through that. But what questions do we have that you would like some insight on? Joni?
I made a mistake when I did my winter week. I could check the box establishment because I was thinking that was okay, your plant commission. And Kevin helped me find that messed me up. So when do you use the establishment one? When do you check that box? I had to check my shouldn't have.
The only time I use the establishment box is when we're putting in a stand of alfalfa in the spring.
But it's something that you're not going to harvest that year.
So I put that in. See, I didn't mark, maybe I did for alfalfa, but I went ahead and did that on my own division, like, okay, 5 years amortized out, and just hand typed in. Would that establishment one have already made that correction? Yeah, because that should give me the full cost of the seed, and it was like amortized out in 5 years. So I did that in my head, and put in the seed cost of $8, but if I put in the 40, would it have already done it? I mean, maybe I didn't use it right.
It does make some adjustment in how FinPack looks at some of those expenses. Like when we took that off, it changed your
Right, it made
numbers
me
in Finland.
something
It made a
that,
big
otherwise I was
difference.
like
So,
100,000 off.
But weren't they, in the examples, didn't they do the establishment year, and then they did a budget for the establishment year that had those upfront costs and then budgets for the subsequent
Right,
years?
it's kind of to identify that as a separate budget from the others.
So rather than advertising, you know, because that seed cost isn't evenly, you incur that all up front.
Yeah.
And then they had those other budgets that reflected also that they changed the production over the several years too. So I mean, they were making multiple budgets for this.
So my day, I guess, I don't have it marked for establishment, and maybe I should have marked my alfalfa hay as established.
No, I don't think we had any plans of planting alfalfa new in this base plan. We were just going to have existing stands, so if he was going to plant some spring alfalfa, we need a specific budget for that because it's only going to yield a minor amount for the year. Yeah, half or less is what it would be. That's about the only time I'll ever use it.
I got that confused, and it made a huge difference when I had that wrong in my head.
I've never used it. I've always done a separate budget for the startup cost and what minimal yield I was going to get
Right.
and allocated it to so many acres. But like Tracy and I are talking, most of the time, the alfalfa is just kind of you factor in about so many acres of new.
A certain
It's kind of
percentage.
if you're just maintaining that total stand by replacing acres every so often. But listen to you guys, we run alfalfa for 10 years now. That
This part of the state it drowns a lot of times. So.
we haven't had any drowning trouble for
you know you have.
25 years.
Did you have drowning 25 years ago?
I think we might have had 1 year, but I don't. I've got one guy that's planted alfalfa 5 years in a row and has not been able to get a stand established in that field. Because it just won't rain.
Other little nuances or questions, concerns?
Did want to just maybe refer a little bit, Jared, you mentioned regarding the value of the pasture or the value of the land and having a different amount, $500,000 an acre difference even on that. If we had something like that on that balance sheet, it's certainly going to make their financial position at that point in time look better or worse, depending on what value you use. When you go into FinLerb and make this projection, the end result actually is it's still not going to cash flow. You know, the numbers of your projection aren't going to be changed by the fact of that. There's even things, the asset turnover ratio that shows based on the projection we did, well, if we raise those values higher, that just makes that ratio even looks worse. So it's, you know, some of those things, the impact of them, you know, has a given impact, and you need to understand where your values came from when you created that balance sheet. What was my basis for the values I used? Have that, know that, but then once you do that, as you go into working with that farm, making a projection as to what are things going to look like, you know, the value of those assets at that beginning point is not going to affect if that works from a cash flow standpoint. Maybe comment on that a little, Dwayne, other experiences.
Yeah, let's look at the output. And there's a couple of key ratios that bankers always key in on that are important. If we can go to the executive summary.
Yeah, FinLerb.
Yeah, in FinLerb. Okay. All right. Let's go on down. Okay.
There we go.
Hold it right there. Okay. The one key ratio that's here that's important to look at is term debt coverage ratio. Now remember, we didn't have enough dollars to pay those term debt payments. Remember, we were $24,000 short. This ratio tells us how many dollars we have available to make term debt payments. If it's less than 1, then we're going to have a negative cash surplus. The banks want to see that be 1.2 or higher. So we have to get something configured differently to make sure that we can meet that need. If it's less than 1.2, it's probably not sustainable. And I've got one banker that told me flat out, he said, I want to raise the margin on the cattle that this guy's farming, raising from a buy-sell ratio of so many dollars. He said, I want it to be great enough so I can make that ratio work. So I did what he asked me to, but I wasn't comfortable with it because it looked like the spread between what he was paying for the cattle and what he was getting for them was too narrow compared to what the market was. But that changed that ratio to where it was positive enough that he knew the regulators would come in and look at it and be satisfied. And he knows his client well enough to know that this downturn that they're in that the guy's going to turn around and buy cheaper feeder cattle, and he's going to work his way out of this. So it's just just something he needed to do from that standpoint. The other ratio that's important to look at, you can go ahead and continue to scroll down. Okay, stop. Okay, the other thing to look at is the operating profit margin. We see 7% here, and that's not high enough, obviously. What we like to see on that cash surplus is we want it to be 10% of the gross farm income less the cost of feeder livestock. So if you take the gross farm income and take out feeder livestock, because that's simply a pass-through, because you're not adding value to the purchase, you're adding value to the cattle. We take that out and we come up with the amount that we have left over. We want that to be 10% of the gross farm income. So gross farm income in this state was, go back up to page 2, Robin. There we go. Oh, come on down a little bit. I'm sorry, go up, excuse me. All right, there we go. Okay, gross farm income was $752,000. Of that, feeder livestock purchases were $324,000. Somebody do the math real quick. Tell me how much that is as far as
428.
Okay.
Gross with that subtracted.
With that subtracted out. So that, we would like that cash surplus to be equal to 10% of that actual 42,000 is what we would like it to be. If we can get there, our term debt coverage ratios will work well, and so will our cash flow. And so that's something that lenders will want to look at, the term debt coverage ratio and the amount of cushion that we have against the gross farm income. We're in an environment right now where it's going to be tough to get that. But that's the goal. That's what we like to see. When somebody has that already and they present me the opportunity of working through a plan where they're going to take on more debt because they're buying land or they're buying more machinery, I show them what happens to that ratio, and they may want to rethink where they're headed. They may be getting in over their heads.
And
So,
you said the cash surplus,
cash surplus.
it should be the 10%.
You'd like it to be 10% of the gross farm income. That's the goal. And up until the downturn in grain prices, well, I saw that routinely.
Oh, that's good.
Yeah.
Where did you find, I mean, I tried to follow you on the screen, you were on page 4, and I thought you were at 7.1%, and all of a sudden you moved from a percent to a dollar amount, so I guess I'm lost on what you're exactly you're looking at.
Well, what I'm looking at is the, let's see, go back to that page 4, or 3 anyway. Okay, everything's got a letter here. So, whoop, go up.
You started
Okay,
out
right
at
there.
7.1.
Okay, operating profit margin, H divided by N, and H would be the return on farm assets divided by the value of farm production. And that gives us an operating profit margin based on what our equity position is in the operation. That's something the lenders will want to look at.
Where does that need to be? Because
Historically,
then you went to the 10% of something or other in the.
I'm sorry.
I was talking more of a cash
Yeah.
thing you were talking about there, a cash surplus, kind of a rule of thumb ratio you were talking about with that.
And you want to speak to the ratio?
Operating profit margin ratio, 15.
It's 15 would be pretty good.
15's actually
The operating profit margin ratio has been running with our top KFMA farms. Through the good years, that 07 to 13, we had a lot of farms 20% and better.
Right.
15 would be good. Something,
12-ish.
yeah, between 10 and 15 or thereabout, I think would be a reasonable level to be at for an operating profit margin. But that is very contingent upon farm type as well. So.
And then what was the 42,000 then that you were talking about?
Okay,
That
40.
goes back to the cash.
That goes back to the cash surplus that was actually negative here, but
Oh, so you're not, then you were talking about it's negative 23,000 on this, but it should have been 42,000.
right.
Okay.
So we
Preferably 42,000.
Okay.
You gotta come up with 60 grand.
Now, where you got the 42,000, Dwayne, is you took the 752, 638 gross farm income, subtracted off the value of purchased livestock down below, Robin. The 324 down, it's on your screen. Right, the 324,000 value of purchased livestock. So the 752 minus the 324 was, somebody with a calculator can.
I said it was 428,000, and 10% of that was
42, 43,000.
we just kind of used it.
I missed the step, I'm sorry.
That's okay. The other thing I want to emphasize is that term debt coverage, on the balance sheet, let's go to the balance sheet for a moment, and the current asset to current liabilities ratio. How many dollars of current assets that are going to be sold in the next 12 months can offset current liabilities? When that gets to a 1-to-1, our working capital is basically consumed. And go to the front page for a moment. Okay, in this case, there was $498,000 of current assets and total current liabilities, including term debt payments that are due on intermediate and long-term liabilities within the next 12 months are brought forward as a current liability. This gets to be a 1-to-1. We don't have a lot of margin for error. If this gets to be upside down, where this is larger than that, we know we're headed for what? A restructure of some sort. We're going to have to do something to free up the operating capital. Otherwise, the line of credit is filled up all the time. And I've got lenders right now that are telling me that we will make a loan to a customer based upon the maximum that their crop insurance will guarantee them, and that's as far as we'll go. I've already got a couple of guys I worked with. That means they're not going to be planting any corn. They're going to go beans and wheat because there's less costs up front to put those in the ground, and they don't have enough credit line that they can plant what probably will make them more money, and that's corn. So it's like a double-edged sword. It's going to catch them both ways. And so I'm having some discussions with one client and his lender about looking into finding another way to increase his line of credit more than what crop insurance is, because crop insurance is doing what, Art? It's giving us less of a coverage every year as the price gets ratcheted down, unless we take advantage of higher levels of crop insurance. But if we're already maxed out, we're at a point where that total dollar volume is not going to be what it was the year before. So that's going to affect the amount of credit that we have. And if we backed it up already at this stage, and we haven't paid much for our spring expenses, where are we going to get our operating capital to run the operation? And we start borrowing on credit cards and grandpa, and it's going to be a tough thing, especially if the profitability doesn't increase. So this is one of the things you want to look at, and one of the things that as you go with us and we work together on these, you'll start to pick up on some of these things. Kevin, you got anything you want to add to?
What a question then?
Okay, yes.
What about like lease payments? Maybe you said this already, but do those go on current liabilities if they're making a monthly lease payment on equipment?
It actually isn't part of the balance sheet per se, but the lease payments themselves are part of whole farm expenses like fuel and repairs and paying taxes and those kind of things.
Just part of the budget?
Yeah, as far as...
Lease payment should be coming out of their checking, so we're accounting for it on...
But it doesn't show up on here because technically it's not a loan, although we got this deal where some lenders want to use the equity you've got in a lease payment, because maybe you had a 4-year lease payment to own on a combine you paid $200,000 for, and you got 1 more year left. Well, as soon as that year elapses, you exercise your right for that last payment in the boot to make that purchase of that combine, and now you've got the equity there that the lender needed today to help give you a greater amount of loan capacity. So a lot of times they'll want to use that, even though it technically from a lender standpoint isn't defensible, but they'll have you put them on there in many cases. So at this point, I guess don't get lost in that. It doesn't happen every day, and we get in a situation where you run into that, talk to us and we'll help you get through it.
So it's more or less going to look like, if they have a lot of lease payments on equipment, it'll look like they're not very profitable, but maybe they can still make their current liabilities, does that make sense?
It can, because the lease payments are an off-balance sheet issue, and I've had people have to go that route because it actually, if they didn't do that, they would be decreasing their overall debt-to-equity ratio because they were taking on debt that was equal to what they just purchased, and it makes their total ratio less, not as good as it could be. So a lot of people will not do leases unless the bank says, we can't make you this loan. And so they'll go to leasing company, and leasing company in many cases will. I've got an operation I'm working with right now that's putting up a closed building that'll hold 5,000 head of cattle. And they did it on a lease basis because their bank said, we are not interested in it. Now, this operation has $24 billion in equity. So they weren't worried about, the bank's not worried about the fact that they don't have the collateral to back it up. They just didn't want to give them $1.5 million loan to build this confinement building for these cattle because they felt like it's never going to cash flow. But the lease company was happy to make the lease payment because they've got lots of equity. Are they doing them a favor? The banker and I would tend to say no. But
Well, keep in mind that leasing is just another form of financing. I mean, it's using somebody else's capital to allow operating to happen. And so while it's called a lease and not a loan, it is a form of financing.
and you won't see it every day. So I guess let's not get too hung up on it, but it does happen occasionally. Other questions, little things that you're concerned about at this point? John, what do you think? You ready to go?
I'm overwhelmed.
Robin, go back to FinPack.
Do you have you put together kind of a reminder of the target ratios? You know,
We're gonna have listed kind of based on what comes out of the KFMA data and historically what's been there, as well as some target rates.
Yeah.
One of the things we do give the KFMA members with a number of those ratios is red, yellow, green bars and where they're at, and the ability to see kind of where have those been historically and where would we recommend those to be at. So
This is on the website right now, but something Kevin and I have on the need to work on is putting together some Kansas numbers of where farms are at right now, and so more benchmarking other than just in bars. So
This is part of the follow-through analysis that will take time for you to get comfortable with. And we don't expect you to be able to do this right off the bat. But we do want to get you used to understanding some things that are pretty basic, like term debt loan coverage ratios and overall profit margin percentages and the current liability to current asset ratios. Those are the three things that are very critical.
I was just going to say to him, Robin, go to there's a page, is it page 3 maybe, or 4, where it has value of farm production. Just wanted to, there it is, yeah, and right there, value of farm production. So if you're looking and comparing a projection you're making with some KFMA data that's on the website or different things like that, we, from a gross income standpoint, what goes into our summary reports or what you'll see there will be value of farm production, and it is computed the same as what this number is. So it's adjusting the gross income by those, like in this case, there was a $324,000 of livestock purchases as an expense. It's making that adjustment as well as an adjustment for purchase feed. So those things have occurred in getting at that value of farm production. But that would be the number that would compare to a KFMA summary report that had the value of farm production line in that summary report is the same as this line on the FinPack report. And then maybe, Robin, go back to the first page of that executive summary. So if you look at key financial measures, those 3 lines, how close are you on your figures to those 3 numbers? The 3256 net farm income, cash surplus minus 24,000, net worth change minus 3,700. Did you come out fairly close? Or are you way different? You're saying, I need help.
Just didn't get that far.
Let me look at that.
Under the key financial measures, the net farm income, cash surplus, net worth change.
It'll be your front page executive summary. Your front page executive summary is where that would be.
How close did you come, Mark? How close were you on those three numbers?
Came in with more than when you were letting it estimate your operating.
Yeah.
I ended up with a higher operating. Close enough. I'm not within the house.
And we're tweaking and going back through some things, you'll pick up on something. Sometimes it's as simple as putting a decimal point in the wrong spot on something. And you can look at it 2 or 3 times and all at once you go, well, crap, there it was all the time and I couldn't see it. So sometimes it takes another pair of eyes. I mean, I've had that happen where one of my analysts will send me a file and say, I cannot figure out what I'm doing wrong. And all it was just a decimal point on a budget in the wrong spot. But, it's just easy to miss a little thing like that. So another set of eyes sometimes can really help with that.
Yeah.
So again, I think the best thing we can do is when you get a referral, we'll go with you at least the first 2 or 3 visits that you have with clients just to get you comfortable with the process. And as you start to work through it, then a lot of these things will be more understandable. You'll start to gain on it. I know right now it's a lot, but you'll get there.
Okay, after the day's things that we've been doing here, you're ready now for a 2-hour presentation on tax implications of these planning decisions, looking at bankruptcy, looking at, okay, maybe not.
Only 2 hours?